let's start talking in depth about capital structure. First question, of course, is what is capital structure? Well, capital structure is the way a corporation finances its assets through some combination of equity, debt, or hybrid securities. The next question should then be, why do assets require financing? Now, think about this from your everyday life, and it'll be clearer. Think about the assets that you own, whether it's a car or a house or both. Think about your house. That's an asset. It required some sort of financing. Now, you might say, well, I paid cash for my house. That's fine. That's 100% equity financing. All assets are financed. Capital structure just describes how they're financed in terms of the split of equity and debt securities required to finance the assets. That's simple enough from a personal standpoint. It gets a little more complicated when it comes to a corporate standpoint. Now, we'll begin talking about the balance sheet of a corporation, which lists assets, liabilities, and shareholder equity. And the first thing that we all remember from accounting class is that the balance sheet must balance. That means total assets must equal total liabilities and total shareholder equity. Well, why is that? Well, assets equal liability plus equity because, remember, if you have $28.5 billion, as this company has, of assets, you had to finance those assets using some combination of debt and equity, meaning that on the other side of the balance sheet, your total liabilities and plus your total shareholder equity should be that same $28.5 billion. And so, to answer the question, what is capital structure, in a very terse, succinct definition, it's the composition or structure of liabilities. For example, a firm that sells $20 billion in equity and $80 billion in debt is 20% equity finance and 80% debt finance. The firm's leverage is 80%. But that brings us to a deeper, more fundamental question. It's easy enough to talk about what capital structure is and define it. That's simple. The bigger question is, does capital structure matter? Now, many individuals in society believe that their financial goal is to be debt-free. This is something that's taught to a lot of people, and it's a lesson handed down through generations. But what financiers and financial professionals know and understand is that debt-free or debt-laden really doesn't matter. It's the cost of capital, the returns, the arbitrage, and the risks that matter. For example, if you could borrow at 9%, invest the money, and generate 14% returns, would you do so? Of course. You would be generating a 5% spread, as it's called in finance. And so, business people do the same thing. They attempt to find the perfect capital structure, percent equity versus percent debt, in terms of their risk-reward payoff in how they want to finance their business. If that's the case, if all that I just said is true, and you're answering it to yourself as I was going along, then it must be that capital structure does matter. So if it does matter, we have to think about it. So then we ask ourselves, how do we think about capital structure? Well, the Miller-Modigliani theorem forms the basis for modern thinking on capital structure. It's the basic financial economic model on capital structure. Now, I want you to be careful before I begin talking about Miller-Modigliani. Be careful and understand that this theorem is purely theoretical, and it disregards key factors in capital structure decisions. For example, the theorem states that in a perfect market, how a firm is financed is irrelevant to its value. And that's the key. That is the Miller-Modigliani theorem. That in a perfect market, how a firm is financed is irrelevant to its value. Notice, in a perfect market. That's the part of the theorem that's purely theoretical. Because, really, in a perfect market, there are no bankruptcy costs, no agency costs, and no information asymmetries. All of the above exist in the real world. Which means, in the real world, capital structure must matter. It must be relevant. Business people want perfect capital structure because they want to exploit the risk-reward payoff. They want to achieve returns by changing the capital structure of a business. They want to use debt to create returns. So then, if capital structure matters, and we want to exploit the risk-reward payoff, and we want to use debt to create returns, then we better start learning how debt can create a return. Here's an example. Let's say we're real estate investors, and we're purchasing an asset, a real estate asset, a strip mall, in fact. Let's say the price of that asset, the strip mall, is $5.3 million, and the strip mall is generating net operating income of $371,000. So if we were to purchase this strip mall for $5.3 million and put $371,000 in our pocket every year, that would be a 7% return. Pretty tidy, impressive, good business. Now let's change things. Let's say with the same asset, same price, strip mall for $5.3 million. But this time, instead of paying $5.3 million cash out of pocket, let's use debt. Let's finance. And let's say that we go with 70% loan to value. That means we put 30% down payment out of pocket and borrow 70% of the purchase price. That means our down payment is approximately $1.6 million. We have approximately $227,000 of debt service every year. And remember that the net operating income hasn't changed at all. It's still $271,000. But now our earnings after debt service, because we have to subtract the debt service from our NOI, is now $143,000. Well, fine, but what's our return in this case? Our return is actually now 9%. That's because we're putting $143,000 a year in our pocket off of only $1.6 million that we spent out of pocket to acquire the asset. And that is how debt creates return. In fact, what debt does, and you'll see here you have two lines. The dashed or dotted line is an unlevered return. The solid line is a levered return. And notice what debt does. When you add leverage, you go from the dotted line to the solid line, which is more positively steep. That's why it's called leverage. Debt acts as a lever. It makes return on equity more positively steep. If you think about how debt creates return, it's all around you. You hear about it all the time and you see it all the time. You think about private equity firms on Wall Street that execute leveraged buyouts. They borrow a bunch of money to buy companies. Well, they're playing the same game we just played with the purchase of the strip mall. Think about hedge funds. We'll see an example in a moment of how a hedge fund uses debt to create higher returns. But even in our personal daily lives with our family and friends, home ownership, mortgages, right? We're put a little bit down out of pocket, buy a house, we put a fraction of the value of the house down out of pocket, and then we capture the equity upside, the capital appreciation of the house. All right, let's see how hedge funds use debt to generate higher returns, just as another example of what's happening here with debt generating higher returns. So let's say we have a hedge fund, and our hedge fund is interested in purchasing Apple stock. And let's say Apple stock is currently trading at $100 per share. Now, our hedge fund will put $100 million into purchasing Apple shares. But since hedge funds borrow, that's not the end of it. The hedge fund, on top of its $100 million equity investment, is going to borrow $900 million and buy a total of $1 billion of Apple shares. Let's say, after purchasing this $1 billion of Apple shares and holding it for a little while, that Apple's share price goes up to $110 per share. The value of the hedge fund portfolio is now $1.1 billion. The hedge fund's total gain on investment is $100 million. Now, the hedge fund had to borrow $900 million, so it had to pay interest on this debt. So let's say, for the time period that it had the debt outstanding, while it held the Apple stock, obviously, the hedge fund paid $30 million of interest on its debt. That means the hedge fund's net gain on investment was $70 million. Now remember, when calculating the hedge fund's return on investment, that the hedge fund only put $100 million of equity down to buy the shares. That means the hedge fund made a 70% return on investment. The hedge fund's return on investment without leverage would have only been 10%. Again, we see debt acting as a lever, why it's called leverage, increasing our return on equity. So now we understand that debt creates higher returns. We've looked at a couple of examples, and it's well known throughout finance this is true. The other question would then have to be, can debt create value? Well, we're talking about Miller Modigliani here, right? And they postulated the theory that forms the basis of modern thinking on capital structure. And Miller and Modigliani say, when asked, can debt create value? No, debt cannot create value according to Miller and Modigliani. And they won a Nobel Prize, so they must be onto something, they must be smart. Well, what Miller and Modigliani are saying, and you can see it with our original example here about the strip mall we were buying, is that the debt created higher returns, but didn't affect value. The price of the strip mall, the value of the strip mall, remained $5.3 million. All the debt did was make our return on equity higher, right? It made that line more positively steep. Why is that? Why can we generate higher returns but not create higher value using debt? Well, Miller and Modigliani made it very clear. In their theory, they stated that, look, the value of a firm is based solely on the firm's assets and is independent of the liabilities used to finance those assets. So here's the firm, and here's how the firm is financed: debt and equity. What Miller and Modigliani are saying is that it doesn't matter what percentage of the firm's financing is debt and equity. Could be all equity, could be all debt, could be any combination in between thereof. Nothing changes, because Miller and Modigliani stated that regardless of how you slice the pie, debt and equity, and you can slice it in many different ways, the size of the pie never changes. But remember, Miller and Modigliani's theory is purely theoretical because it describes the functioning of a perfect market. And remember, in a perfect market, you don't have bankruptcy agency costs or information asymmetries, which you do have in the real world. So what does that mean? It means that in the real world, capital structure is relevant because a company's value is in fact affected by the capital structure it employs. In the real world, debt can actually create value if the benefit of the debt exceeds the cost. This goes back again to that first question I asked, or one of the first questions I asked in the beginning of this lecture. If you could borrow at 9%, take that money and invest it at 14%, would you do it? And of course you should have said yes in your own mind. Right now, you couldn't do that in a perfect market, because in a perfect market, there's no such thing as arbitrage, right? In a perfect market, the market is perfectly efficient. Okay? In the real world, that's not the case. Okay? So in the real world, debt can create value if the benefit of the debt exceeds the cost. Okay? And you think about this, right? You think about your own life, and you think about how corporations behave. They use debt for asset purchases. Okay? Those asset purchases, as well as the other things that can be done with debt, can create higher operating efficiency. Also, it creates managerial discipline, meaning when you're an executive at a company that has a bit of debt on the balance sheet, you have to be more careful, and you have to operate the company in a more careful way, and that's oftentimes good for the company. Also, debt creates value because of creating risk-reward trade-offs. We'll talk about that in a second. And of course, in the real world, taxes exist. And when taxes exist, you have a tax code. And in most tax codes, the interest on debt is tax deductible. And that increase in net income accrues to the value of the firm. All right, let's talk about risk-reward trade-off and taxes. First thing we need to understand in terms of debt creating value is that debt creates value by adding risk. Think about the example of the house again. Say you put a 10% down payment on a house. Let's say the house increases in value by 10%. How much value have you created? Well, actually, you've doubled your investment at that point. You've created 100% value. But what if the house falls in value by 20%? How much value have you destroyed? Well, at that point, you've lost not only what you put in, but 100% more. And notice how you took a risk, right? You took a risk of losing a lot to make that debt create value for yourself. The example of a hedge fund is a perfect one. Notice how much risk the hedge fund had to take by borrowing $900 million in order to make that big return on investment. Imagine if Apple stock had declined by $10, $15, or $20 per share. The hedge fund would have taken a bath. And so when you think about capital structure, and you think about debt in a capital structure, think about this. Think about the risk. When a firm issues debt and equity securities, it splits cash flows into two streams. A safe stream that goes to the bondholders or the creditors, and a risky stream to the stockholders. Higher debt ratios lead to greater risk and higher required interest rates to compensate for the additional risk. Remember that. Okay? So if you think about financial risk, it's the additional risk placed on the shareholders as a result of the decision to finance with debt. There's a shift in the risk here. Okay? So if you think about business risk for a second. A typical company has a lot of different business risks. Variability of its demand, variability in sales price, whether or not it can hold its sales price steady, changes in the costs of its inputs that it needs to create its products, ability to develop new products, foreign exchange exposure a lot of times. Companies face a lot of business risk. Now, here's an example of what happens with that business risk. Suppose 10 people decide to form a corporation to manufacture disk drives. Old example, right? Because disk drives are going to become extinct soon. But if the firm, actually they're probably already extinct, if the firm is capitalized only with common stock, and if each person buys 10% each, right, that means each investor shares equally in the business risk. The risk is spread equally among all of the investors. Now, if the same firm is capitalized with 50% debt and 50% equity, with 5 people investing in debt and 5 investing in equity, the 5 who put up the equity will have to bear all of the business risk. So the common stock now becomes twice as risky as it would have been had the firm been all equity financed or unlevered. So that's one of the ways one of the ways that debt is creating value here, is that financial leverage concentrates the firm's business risk on the shareholders, because the debt holders receive fixed interest payments and bear none of the business risk. Okay? Leverage increases shareholder risk. Now you remember, we talked about it in the prior lecture. Risk and return are commensurate. The higher the risk, the higher the return. And so you see why adding leverage, which adds risk, increases return on equity, because it's compensating for the higher level of risk. And another reason why we see that when we lever, we have a steeper return on equity. It's because of this relationship. So you think about, and going back to investment generates return, one of the reasons we're compensated for holding any financial instrument, including common stock, which means ownership in a company, is risk. Now, all investments have a net present value of 0. This should be familiar because in the prior lecture we talked about how in equilibrium all assets and financial instruments pay the same return, which is 0. But another concept I want to talk about right now is that all investments have a net present value of 0. Okay? And you know the NPV equation goes like this. Net present value equals the first negative cash flow plus all of the positive cash flows going forward, discounted to their present value by 1 plus some discount rate. Right? That's the net present value equation. Okay? So if in equilibrium all assets pay the same return, 0, and all investments have a net present value of 0, then what must be happening in order to create higher net present value, if you notice, is you're just making the discount rate, or the rate of return, higher, going from, say, 3% to 7%. And that's one of Miller and Modigliani's main points, is that debt isn't actually creating value. It's just trading safe cash flows for risky cash flows. That's not creation of value. That's simply being compensated for taking more risk. Because remember, in a perfect market, okay, in an efficient market, arbitrage doesn't exist. But then again, we run into theory versus real life. And in real life, arbitrage does exist. And markets are inefficient. And we have cheap liquidity, where you can borrow at very low rates and invest that money into high-yielding equity. Invest that into equity and high-yielding assets. Okay? In the real world, in markets today, we have underpriced risk premia, for example, because of cheap liquidity and because of Federal Reserve policy. So all of these things actually exist in the real world. And of course, in the real world, we have certain advantages of debt. For example, interest is tax deductible, so it lowers the effective cost of debt. Debt holders are limited to a fixed return, so stockholders don't have to share profits if the business does exceptionally well. Again, that's an arbitrage situation, right? That's taking advantage of perhaps an underpriced risk premium or cheap liquidity. Okay? Debt holders don't have voting rights, meaning their money comes in, right, but it doesn't change the decision-making of the business. The United States tax code allows corporations to deduct interest payments on debt as an expense. Dividend payments to stockholders, on the other hand, aren't deductible, right? So this differential treatment results in a net benefit to having financial leverage. Of course, there are also disadvantages to debt. Higher debt ratios lead to greater risk and higher required interest rates to compensate for the additional risk. Higher debt ratios lead to higher risk of default or bankruptcy, and the risk of default carries serious costs. However, what we have to take away from this lecture is that there is such a thing as optimal capital structure. The more leverage, the more tax savings. Therefore, do we want as high leverage as possible? What if leverage approaches 100%? Then the firm is bankrupt. What if you can't pay the interest when cash flow is low? Then the firm is in default. And this happens during every recession, every financial crisis. I've been a financial restructuring banker. I've dealt with it. So theoretically, in that case, creditors take over. That's called financial distress. So the way we want to think about it then is to think about this graph, where we have on one axis the market value of the firm, and on the other axis the debt to total asset ratio. And here we have a flat line, and that line is the value of an unlevered firm. The value of the levered firm, by contrast, isn't a flat line at all. Its market value is rising as its debt to total asset value is rising. However, there's another line that's about to come here that's rising, and that line is the cost of financial distress. And notice that line keeps going up, while the value of the levered firm actually meets some limit, flattens out, and begins to decline as soon as it meets the cost of financial distress. And what that tells us is that the point where the cost of financial distress meets the value of the levered firm increasing because of the increase in debt to total assets, and the value of the levered firm then begins to decline, that point in market value is what you want to maximize as a business person in terms of debt to total assets. That's the optimal amount of debt that you would want in your capital structure, right there at the maximum point. So optimal capital structure, what makes it optimal is that you have maximum leverage before financial distress becomes a non-negligible risk.